Welcome back to the Argyle SMB Finance Leadership Forum. My name is Brittany Sullivan with Argyle, and it's great to have everyone joining us today. A couple of notes before I turn things over to our esteemed speaker. First, a quick reminder to stop by our sponsors' virtual booths at any time during today's event and for the following week. Our partners are committed to providing you with valuable content and a great overall experience. At any time during today's event, you can visit their virtual booths from the main agenda page, which includes complimentary materials, information, and meet and greet opportunities. To ask questions throughout the session, simply type into the Q&A chat, and we will address your questions at the end of the session. Now, without further ado, I would like to introduce our speaker, Shweta Pai, Chief Financial Officer at Book & Street. We're excited to have Shweta with us for a keynote titled Capital Allocation Strategies for Growth. Welcome, Shweta, and over to you.
Thanks, Brittany. Hi, everyone. Thank you so much for having me. I'm going to talk about today capital allocation strategies for specifically for small businesses that are geared towards growth. We'll talk about some of the key trends that we see in the market for 2023 and the near term, as well as what are some of the key keys to success when you're thinking about capital strategies as a CFO and how to allocate the capital that you do have, which is very limited for small businesses. Just as a quick intro on who I am and what I do. So as Brittany mentioned, I'm the CFO of Book & Street. I also have worked in finance strategy for about 20 plus years. At Book & Street, we specialize in startup solutions for finance, but then we are also all about the back end. But what this does is it gives us visibility into what's happening in companies that are small startups, but also venture-backed or private equity-backed companies, and anybody up until really pre-IPO, which is small and medium size. And given that we're in the Midwest, it tends to be pretty much in the small end of the spectrum rather than the medium size end of the spectrum. But just wanted to kind of give you that preview into that this is really what we do. And because of our visibility into this broader companies, when we go across industries, we also go across business evolutions. But one of the key things that we're constantly talking to our clients about are around capital allocation. It's so limited for startups and especially small companies that we have to be very clear on exactly how that capital gets allocated and how it's aligned to the overall growth and overall goal and objectives and vision for the company. Now, I just wanted to kind of level set ourselves about really the 4 key allocation methodologies that we tend to see. And this applies to everybody. Some as companies evolve, and my background was before I had startups about a decade ago, I was in large investment banks and other large companies, manufacturing, et cetera. So for very large companies, they tend to veer more towards acquisition and repurchasing. But for small businesses, a lot of the allocation strategies are geared towards organic growth, as well as an area that is near and dear to my heart, but often gets forgotten about in this area of when we're talking about growth, is investing in infrastructure. Now, let's just talk about each one of them very, very quickly. New products, markets, organic growth, investing in organic growth is often seen as the best way to drive profitability, because it does a few things. It helps you build that competitive advantage, but the things that have made the company succeed till then, such as the company culture and their way of doing their MO on how they actually address and how they present themselves to the market tends to remain the same when we're doing organic growth, which builds a consistency that is really attractive for a lot of smaller businesses. Then we also have another avenue for capital allocation, which is acquisition of new products, businesses, customer books, and it can also be economies of scale. And this is where a lot of larger companies go into when you're investing and acquiring for economies of scale. In those instances, the capital allocation, it can be one of those quick wins, but it's also comes with a higher level of risk, because with new businesses, it comes new cultures, new talent that may or may not integrate well with you, as well as new ways of managing and interacting with your customers. So that's one on a little bit riskier end. We also have another capital allocation strategies that is much more on the executive end, and it's around shareholder management and how do you give capital and return capital to your shareholders, to your investors, either via dividends or repurchasing shares. Now, this can be also a really useful way of boosting the value of your company, but often for growth, it doesn't necessarily allow companies, especially smaller companies, to grow as much. But it can attract the times where we've seen this strategy used even for growing companies is when they are looking to actually attract new investors in or build that confidence and trust with the investors. That's when we see repurchasing or dividends much more common, but we don't see it very often. The other area that is a huge area, and we're seeing that in a lot of different industries, especially, and we'll go into the trends, has been this idea of investing in infrastructure. So companies are investing in a lot of digital tools, but also supply chain strategies. And we'll talk about some of the new tech and trends that we have. But this investing in infrastructure, I place that last because it's about investing in yourself. So using your capital to allow and ensure that you are in the right place for growth and to scale and to manage that in, again, a sustainable manner. But one of the big things has always been around also customer experience. And for a large company or a smaller company, for them to ensure that they are in the right place in order to grow, that customer experience is often key. So we see a lot of capital being allocated towards infrastructure costs, infrastructure investment, even though that kind of goes counter to what you would imagine would be the way for growth. But these infrastructure, it's almost like delayed gratification. You're investing them now, but they are there to allow you to scale, allow you to grow. Now, let's talk about the big trends. So what do we see as far as capital allocation for 2023? What are we seeing in the market? First off, what we see in the market has been very heavily driven towards technological investments. So they come in different kind of areas, and because it's not just, oh, I'm going to invest in tech, it's what kind of tech. So one of the big areas has been what we talked about around digital transformation. This applies to customer experience, but it can also apply towards internal employee experience, as well as enhancing your processes internally. But we're seeing a lot around digital transformation, customer facing digital transformation. The other thing that has kind of crept up over the past few years has been a huge amount of capital towards cybersecurity. What we're seeing is a lot of and we tended to see that often with large companies, but now even with smaller companies, and appropriately so, we're seeing a lot more security protocols, threat detection, awareness training. I mean, on the finance side, especially around cash management, we've seen a lot more focus around cybersecurity and around ensuring that there are appropriate controls in place so that money isn't moving in and out of bank accounts without the appropriate protocols in place. So that's a huge trend that we've seen recently. We're also seeing, I mean, should be a surprise. This has been going on for quite a better part of a decade around cloud computing. This has been around, again, setting yourself up to be scalable. And we see a lot of smaller companies go towards cloud computing because it allows them not just to scale, but also be flexible at a much lower marginal cost. And that marginal cost is what drives a lot of their decision making, which is what cloud computing and in general moving data information onto the cloud allows them to do. This has definitely accelerated. We've seen it for a long time, but it accelerated through the pandemic because of remote working and remote access and people requiring and needing that remote access. The other area has been, and this is much more recent, has been around the comfort that people have around AI and machine learning. So ML is machine learning. And we're seeing this very particularly in automating kind of the back-end processes. It's not just back-end, but we're seeing a lot of that, about automated processes for finance, but also HR, payroll. There are a lot more virtual assistants being invested in, chatbots. And then when we talk about customer experience, we're seeing a lot more predictive analytics being applied. And again, this is specifically, there are two kind of areas. Again, one is for scalability, but the other one, when it's customer facing, tends to be that capital allocation tends to be around customer experience and making sure that you understand, given how dynamic and fast moving markets have been, and how powerful AI and ML can be in looking at predictive analytics and just data in general that so many companies have. We're seeing that being applied quite a lot. The other big area has been Internet of Things. Now, IoT was a buzzword probably about 6-7 years ago. But now what we're seeing is people are talking less about it, but what's happening is that there are a lot of interconnected devices coming in, and this is being used specifically to streamline operations. And again, we're seeing that used for growth in order to grow fast and grow into new markets, new products, but doing that with streamlined operations. We're seeing this being applied to logistics, supply chain strategies, as well as anything around how information is moving through the companies as well. So that has been a very interesting kind of top big investments that we continue to see. And I mean, this is on this, if we put aside the acquisition and inorganic growth, these are kind of where we're seeing a lot of energy being put into. And one big thing I should also mention is while a lot of companies are using these tools to make themselves operate better and to grow, there's also a whole other part where it's these same tools, but they're being used to actually go into new markets, into new products, develop new products using AI and ML, using digital transformation, providing and opening yourselves up to a completely new geography, a completely new customer segment that was never there before. So we're also seeing that on both sides, both organic growth as well as investment in infrastructure. So those are kind of the top ones that we thought of that just came off the top of our heads. But one key thing that we also I really wanted to kind of talk about was capital allocation. And when you have a lot of capital through, either your own growth or, if you're bootstrapping or through investors or a capital raise, what have you, whenever we see capital allocation methodologies be used, one of the big differentiators for success has been around how well the executive team can manage communication on what that capital is meant to do and what that capital allocation is driving and how it's going to drive growth. And so shareholders who are the biggest stakeholders in this capital allocation are almost always hungry for communication, but we see that when they don't get it, that's when things can contract quite a bit. So for effective capital allocation, what we found almost always has been when the executive team has transparent communication with their shareholders. By transparent communications, it's not just about letting them know, hey, this is what we're using this capital for, but it's also to build in goals, objectives, metrics, KPIs, dashboards around what do we expect to get from this capital? What is the ROI? How are we tracking that ROI? What is the expected kind of, for the plan? How does this fold into our budget, into our forecast? How does this flow into other areas of our existing business? And the ones that the key to transparent communication has also been the executive team that provides context. And this we find doesn't happen as often as you would expect. But when teams are often making these decisions, they know a lot about the market, the competition, what are the requirements, or what kind of a risk are they really taking? But that doesn't get translated down to the shareholders or investors on a regular basis. But the executive teams that actually do provide that kind of context are the ones that tend to succeed really well. And and the other thing has also been in tandem with this, and this is very rare, but does happen more for small companies than for larger companies, is feedback loop with your key investors or your board. But having that feedback loop, that consistent communication, not only gets buy-in from the shareholders, but also you get different perspectives. So we see a lot of executive CEOs, owners, founders do this. And when they open that feedback loop up and provide that consistency for investors, that's when there is almost always a buy-in and also support, whether it's through opening them up to other ideas, but also to other networks that the investors may have, et cetera. And of course, this goes without saying, one of the keys to success is always to have decision support built into how you're going to course correct your capital allocation if as appropriate. Now, we can't really talk about capital allocation without referring to how we mitigate risk. One of the big ways that we have seen has been around risk mitigation, but risk mitigation almost, it goes into kind of four big buckets. A due diligence, so thorough analysis of your market, your growth prospects, who's your competition, what is the expected liquidity, returns, etc. That's required. It's almost table stakes. And then, as we've seen from the big bank failures, as well as other big, faux pas that we've seen companies make, a lot of times it all falls down to diversification. We have to make sure that whatever we're doing with our capital, that we're diversifying across industries, customer segments, geographies, asset classes, however you define your customers and your assets and your market position. Diversification is one of the big ways of mitigating risk from your capital allocation. We talked about metrics and KPIs, but that's required for risk mitigation for a variety of things. You understand what is happening, but you also can course correct. The key here has been, and we have to remind a lot of our clients, is that we have to make sure that our KPIs and dashboards have leading and lagging indicators. Lagging indicators are typically the ones that everybody kind of goes towards, but leading indicators are often the ones that can really help you with decision support and making the right decisions. The other thing is always, for finance, especially for finance leaders, is to have the right contingency plans. We have to have the right cash reserves, lines of credit, et cetera, in order to be able to mitigate risk. So these are kind of the big key areas of mitigating risk for however you choose to do your capital allocation. So with that, I'm just going to stop and pause. I know we shared a lot of information. I would love to hear more from everybody. And see if you guys have any questions, anything that you wanted to add, anything more that you wanted me to share. I'm up for any such ideas or thoughts. Please share.
Great. Well, thank you so much, Shweta, for such an insightful keynote. As a reminder, audience members can still enter questions. We could go ahead and review a few that came through. This first question asks, how often do you suggest evaluating investing strategies for adjustment?
Yeah, that's a great question. So, as with anything, it does depend. It depends on the company, on what you're doing. I mean, I would say, as just a finance person, in general, your as often as you look at your strategic long-term plan, that's definite. You have to look at it. Now, best practice for timing of capital allocation is at least once a year. And some companies do it more as on an 18-month cycle where they update that long-term strategy. So that's one area for sure. But then the annual budget is another time that is a great time to look at your capital allocation, make sure that you have your CapEx plan in place, et cetera. So that's another great time that we see. And the ones that are really very active in capital allocation, they include this actually as part of their rolling forecast. So whatever that rolling forecast is, most often quarterly. Now, this isn't looking at all of your capital allocation. As with anything that is a rolling forecast, it kind of flows down from that strategic plan down to whatever your annual budget was, and now down to your rolling forecast. But the best practice is to update your capital allocation, or to have and make sure that those dashboards, KPIs, are being reviewed on as often as is appropriate for your culture. If you do a rolling forecast, that's almost always a good time to look at your CapEx spend annual budget is a good time to make sure that you're looking at your big ticket items and you're tracking them correctly, and that you have the right KPIs and metrics in place, and those leading lagging indicators. And then, of course, the larger strategic decision has to fall with however often you look at your strategic plan.
Excellent. Thank you so much. This next question, from what you've seen, how important is creating banking relationships for small business startups?
No, that's a great question, especially in today's environment. So we see that it is very important. I mean, credit is a type of capital that is available to a lot of companies, especially small companies, and can come in to help them really with working capital. Where it tends to be most applicable are the type of companies that are most at that have working capital risks. So that's where we see a lot of banking relationships. But again, like with anything, we'd always look at maintaining those banking relationships, but also having a contingency that is diversified. So if you're going to go with a regional bank that is very specialized, or a niche bank, also have a line of credit ready with a global large bank, or vice versa, so that you can make sure that you have available lines of credit at whichever, for whatever you need to do, and regardless of what happens to the broader macro environment.
Great, thank you. This next question, how do you recommend small businesses manage all of these priorities, especially when by nature they have limited staffing?
Yeah, I mean, talent is always comes at a premium in a small business. So the ways that we've seen it has been now building in automation has been a game changer for many. And of course, you can always do staff aug type of companies that come in, similar to kind of the company I work for, as well as a few others who will come in to help on a as needed basis. So right around budget time, just get a few people in who know, who can work the system and make sure that your budgets are inputted correctly, et cetera, et cetera. So that's one way to do it, but it's not necessarily always ideal. The best way is honestly to build in and invest in those processes. Nowadays, you have so much automation within your financial processes that you can have, I've seen baseline budgets be built out already for CFOs that all they do is they're just reviewing that. So a lot of times automation can be, and this machine learning, I don't know about AI. I think AI is probably a little bit further out, but definitely machine learning can be really interesting given how much data we really collect and how much data we have.
Great, thank you. It looks like we have time for one last question. What are best practices for ensuring cash flow needs are met, especially during times of economic uncertainty?
Yeah, I mean, cash is always king, as we all know, especially for small businesses. So effective cash flow management strategies include, working capital management has to be prioritized. And what we're also seeing is a lot of processes being built in order to kind of shorten those the days receivable. So we are seeing a lot more focus on that. But for a small company, that's not always possible. So then what we're seeing for small companies is often that it's the payables, extending that out so that you have more access to more cash, while you're doing what you can with the receivable. But especially if you're a B2B business and you interact mostly with large companies, your leverage there tends to be much lower. than on the payable side. So we're seeing a lot more around vendor management, around payables, and extending those days. And so those are kind of the big trends that we're seeing around working capital. Around CapEx, and around capital for a more immediate capital, again, it goes down to for small businesses, these are they tend to be very strategic. But what we're seeing is a lot of companies invest in sustainable technology that allows them to scale really fast. And it all depends on the kind of growth that they've seen. Ones that are hyper growth invest a lot in themselves in order to be able to scale. But again, it always comes down to working capital management and having a CapEx that's manageable, that you don't really go beyond. So those are the big cash management strategies that we've been seeing.
Excellent. Well, thank you so much again, Shweta, for such an incredible keynote presentation. And thank you so much, everyone who joined us today for this fantastic session. This session, along with all of today's content, will be made available on demand following the event. Thank you again for joining us and engaging in our content. Have a great rest of your day. And thank you again, Shweta.
All right, thank you. Thanks, everyone. Great questions.